Imagine a quiet Tuesday afternoon where the digital architecture of the global economy shifts by just a few millimeters, a movement so subtle that the average person checking their balance wouldn't even notice, yet so profound that it signals the beginning of the end for banking as we have known it for 3 centuries. On January 27th, 26, a document was quietly released from the research desks of Standard Chartered that sent a cold shiver through the executive suites of every major financial institution in the United States. It wasn't a forecast of a stock market crash or a sudden geopolitical conflict, but something far more relentless. A documented alert that $500 billion is currently poised to flee the American banking system. This is not a speculative theory or a worst-case scenario devised by doomsayers. It is a mathematical inevitability driven by a structural flaw in how banks hold your money. While you were sleeping, the foundations of traditional savings were being undermined by a new breed of digital asset that offers something the banks simply cannot match. What the insiders at Standard Chartered see, and what the mainstream media is only beginning to whisper about, is a mass exodus of capital that could leave the traditional banking sector hollowed out, transformed into a relic of a pre-digital age. The $500 billion drain has already begun, and if you are holding your life savings in a standard commercial bank account, you are standing directly in the path of this migration. The document at the center of this storm points to a specific terminal problem: the death of the interest rate margin. For decades, the social contract of banking was simple. You give the bank your money for safekeeping, they lend it out at a higher rate, and in exchange for your liquidity, they provide a modest return and the promise of security. But that contract has been fundamentally broken. As of early 26, the yield differential has become a chasm that no rational actor can ignore. While the average American bank is still offering a fraction of a percent on standard savings, yield-bearing stablecoins, now backed by the full transparency of the newly implemented federal regulations, are offering 4, 5, and sometimes 6%. Backed by the exact same United States Treasury bills the banks themselves hold. The realization is hitting the institutional world first, but the retail wave is right behind it. Standard Chartered's analysts are warning that this is not just a temporary shift in sentiment, but a permanent relocation of wealth. When $500 billion moves from point A to point B, it doesn't just disappear, it changes the gravity of the entire system. Banks that relied on sticky deposits, money from people who were too busy or too uninterested to move their cash, are finding that in 26, there's no such thing as a loyal depositor, when the cost of that loyalty is thousands of dollars in lost interest every year. But here's where it gets critical. The speed of this flight is being accelerated by the very laws meant to control it. The passage of the Genius Act was supposed to bring the wild west of crypto to heel, providing a framework for stablecoin issuers to operate with federal oversight. Instead, it did something the banking lobby never anticipated. It gave digital assets a federal seal of approval. By creating a clear regulatory pathway, the government inadvertently removed the final barrier for the most conservative pools of capital in the world. Pension funds, university endowments, and corporate treasurers who were once terrified of the crypto label now see federally regulated stablecoins as a superior form of cash. Standard Chartered's report highlights that the exodus is hitting regional banks with surgical precision. Institutions like Huntington, M&T, and Truist are finding themselves on the front lines of a liquidity war they are not equipped to win. These banks have trillions of dollars tied up in long-term low-interest loans, mortgages, and corporate debt issued when rates were near zero. They are trapped. If they raise their deposit rates to compete with stablecoins, their profit margins collapse and they become insolvent. If they keep their rates low, their deposits vanish into the digital ether. It is a mathematical trap with no visible exit. Let me walk you through the data of what is being called the Great Deposit Migration. According to the latest Federal Reserve Flow of Funds reports, commercial bank deposits have seen their sharpest quarterly decline since the regional banking crisis of 23. But the context is different now. In 23, the money stayed within the banking system, moving from small banks to too big to fail giants like JP Morgan. In 26, the money is leaving the banking system entirely. It is flowing into digital vaults managed by entities like Circle and the newly launched Tether USAT, where the overhead is a fraction of a traditional bank and the transparency is absolute. This is a silent bank run, conducted not by people lining up at ATMs, but by algorithms and treasury management software moving billions at the speed of light. Standard Chartered identifies that the $500 billion flee is just the first phase. They project that as the infrastructure for these digital dollars becomes integrated into everyday apps like Apple Pay and Fidelity's brokerage accounts, the psychological barrier for the average citizen will vanish. The bank branch on the corner is becoming a museum, a physical monument to a slow, expensive way of moving value that the world no longer requires. The midpoint of this crisis reveals a hidden mechanism that reframes everything you thought you knew about financial safety. We have been taught that the Federal Deposit Insurance Corporation, or FDIC, is the ultimate backstop. But the FDIC was designed for a world of physical constraints and slow-moving panics. It was not designed for a world where $500 billion can reallocate in a fiscal quarter because a Standard Chartered report confirmed what the market already suspected. There's a structural contradiction at play. The more the government regulates stablecoins to make them safe, the more they become a direct superior competitor to the banks the government is also trying to protect. You cannot have a stable, federally backed digital dollar and a traditional fractional reserve banking system coexisting in their current forms. One is an efficient, one-to-one backed system. The other is a leveraged legacy system built on the assumption that you will never ask for all your money at once. The Standard Chartered alert is essentially a notification that the ask has begun. When the world walks away from the bank, they aren't just looking for better yield. They are looking for a system where their assets aren't being lent out 10 times over to fund commercial real estate projects that are currently standing half empty in declining urban centers. History provides us with a haunting parallel to this moment, though the scale today is vastly larger. Consider the money market fund revolution of the late 1970s. Back then, banks were limited by Regulation Q, which capped the interest they could pay on savings. When inflation spiked and money market funds began offering market clearing rates, billions of dollars fled the banks almost overnight. It nearly destroyed the savings and loan industry. What we are seeing in 26 is Regulation Q on digital steroids. The stablecoin is the 21st century's money market fund, but with instant settlement, global portability, and programmable features that make a traditional bank account look like a rotary phone. The mainstream explanation is that this is just a trend or a niche shift for tech-savvy investors, but the evidence suggests otherwise. When Standard Chartered, a bank that has survived for over 160 years, issues a fresh alert about a $500 billion flight, they are not talking to hobbyists. They are talking to the sovereigns and the institutions that move the needle of global liquidity. They are documenting a systemic failure of the traditional banking model to provide value in a high-velocity, digital-first economy. But here's where the situation turns from a financial trend into a personal consequence. If the Standard Chartered projections hold true, the death blow to bank margins will lead to a dramatic contraction in credit. If banks don't have deposits, they cannot lend. This means the mortgage for your next home, the loan for your small business, and the credit line that keeps your employer's payroll running are all at risk. We are entering a liquidity trap where the money is plentiful in the digital asset ecosystem, but scarce in the traditional economy. This is why the timing is so critical. The Federal Reserve has already been forced to inject over $200 billion in emergency repo operations in the first 2 weeks of January 26 to keep the interbank lending markets from freezing. They are trying to plug a $500 billion hole with a $200 billion Band-Aid. The implication is unavoidable. The traditional banking system is becoming a closed loop of declining utility, while the digital asset rails are becoming the primary highway for global capital. If you're not positioned to move with that capital, you are staying behind in a system that is fundamentally losing its ability to support your financial future. Imagine a relatable scenario. A small business owner in Manchester or a retiree in Arizona. For 20 years, they've kept their liquidity in a high street bank. In 26, that bank, squeezed by the exodus Standard Chartered describes, begins to implement maintenance fees just to keep an account open. They limit daily withdrawals to protect system stability. Meanwhile, the business owner's competitors are using stablecoin-based treasury accounts to earn 5% on their cash, paying their global suppliers instantly for a fraction of a cent, and using those digital assets as collateral for instant, low-interest loans. One business is operating in the future. The other is struggling to survive in a decaying past. This is not a hypothetical. This is the divergence occurring right now. The Great Flight is not just about numbers on a screen. It is about who has access to the most efficient tools of wealth preservation. The Standard Chartered alert is a signal that the window to be an early adopter is closing, and the era of being forced to adapt has begun. The risk is no longer that crypto might fail. The risk is that the bank might stay exactly the same, while the world moves on without it. The revelation of this trajectory is both dramatic and logical. We are witnessing the unbundling of the bank. The bank used to be the only place for payments, savings, and credit. Now, payments are handled by fintech, credit is being moved to private markets, and savings, the very heart of the system, is moving to stablecoins. What is left of the bank? A heavy, expensive physical infrastructure and a mountain of regulatory compliance. The Standard Chartered report is essentially a coroner's report for the traditional deposit model. The unavoidable conclusion is that within the next 36 months, the banking landscape will be unrecognizable. The $500 billion currently fleeing is just the smart money, leaving the room before the door locks. The consequences for your savings are real. As banks lose their cheapest source of funding, they will become more desperate, more fee-heavy, and more prone to the kind of liquidity events that saw the downfall of giants in the past. The time to wait for more clarity has passed. The Genius Act provided the clarity, and Standard Chartered provided the data. To reduce your exposure to this systemic shift, you must move from a posture of passive observation to active preparation. First, audit your current banking relationships and identify the net interest margin health of your primary institution. If they are a regional bank with heavy exposure to commercial real estate, your deposits are effectively funding their past mistakes. Second, explore the transition of a portion of your emergency savings into federally chartered yield-bearing stablecoins, ensuring you are using providers that offer one-to-one backing in short-term U.S. Treasuries. Third, diversify your digital presence across multiple regulated jurisdictions to avoid being trapped by a localized capital control event. Fourth, educate yourself on sovereign custody solutions, as the ability to hold your own digital dollars will be the ultimate form of financial insurance in the coming decade. Fifth, reevaluate your investment portfolio to include the picks and shovels of this new infrastructure, the companies building the digital vaults, and the settlement layers that Standard Chartered identifies as the winners of this exodus. Finally, maintain a high liquidity position. In a system undergoing a $500 billion migration, the ability to pivot your capital in minutes rather than days will be the difference between growth and erosion. As we look back at the quiet Tuesday when this report surfaced, we must realize that the warning signs were never hidden. They were simply ignored by those who found comfort in the status quo. The banking system as we knew it was built for a world of paper and slow-moving trust. That world is gone, replaced by a reality where value moves at the speed of thought and the traditional bank is a bottleneck, not a gateway. The $500 billion fleeing the system is not a crisis for the money. It is only a crisis for the institutions that failed to evolve. Standard Chartered has given us the roadmap to the great exodus. The patterns are evolving, the liquidity is shifting, and the digital dollar is no longer a fringe experiment. It is the new foundation. Stay ahead of the curve because as these patterns continue to unfold, the most dangerous place to be is exactly where you've always been. The digital silence of the vaults is growing louder, and the only question remaining is where your capital will be when the migration is complete.